Something just broke in 40 million American balance sheets. And the fracture isn't visible in home price charts or mortgage rate headlines. It's buried in the mathematical architecture of the most leveraged asset class in human history. I am Ken Au. Welcome to The Vault. Today, we expose the $12 trillion housing trap. And by the end, you'll see the exact timeline for collapse. The surface event appears routine. Regional housing markets showing minor corrections. Mortgage applications declining slightly. Commercial real estate facing isolated stress. The kind of cyclical adjustments that financial media dismisses as healthy normalization. But this isn't market normalization. This is the controlled demolition of the greatest wealth illusion ever constructed. This is the systematic transfer of 40 million homes from individual ownership to institutional control through mathematical inevitability disguised as market forces. The housing system wasn't supposed to reveal its fundamental instability this obviously. The unwinding was designed to happen gradually through managed decline and orderly deleveraging. The debt destruction was meant to be invisible until completion. But someone accelerated the timeline. Someone realized the leverage had reached mathematically unsustainable levels and deployed the nuclear option before natural market forces made the collapse unmanageable. Because that's what we're witnessing. The nuclear option. The systematic destruction of housing wealth as the primary store of American middle-class savings. This is where things stop making sense to anyone still believing in property value stability. For 4 decades, the housing market has operated on borrowed optimism funded by exponentially increasing debt levels. Mortgage debt jumped $21 trillion in 2 years. Not growth through increased productivity, leverage through decreased underwriting standards. The system created artificial demand by making borrowing essentially free while restricting supply through regulatory constraints that kept construction below replacement levels. This mathematical impossibility required continuous expansion of credit availability to maintain price momentum. Every previous housing cycle followed natural supply-demand dynamics with corrections that brought prices back to fundamental valuations. The current cycle operates on pure financial engineering, where prices became completely disconnected from economic reality. Median households now require 41% of gross income to afford median-priced homes. Historical, sustainable levels max at 25%. We're operating 60% above mathematical viability. This doesn't happen by accident. Housing markets don't accidentally engineer themselves into mathematical impossibility. This represents coordinated manipulation by entities that understand exactly how debt-based asset bubbles function and position themselves accordingly. Someone knew the leverage had reached terminal levels. Someone calculated the precise timeline for systematic collapse. Someone prepared the institutional mechanisms to capture the wealth transfer when individual homeowners could no longer service impossible debt loads. The timing reveals the coordination. Federal Reserve mortgage-backed securities purchases reached unprecedented levels exactly when private institutional buyers began systematic single-family home acquisition programs. The institutional buyers positioned themselves for distressed acquisition, while homeowners were qualified for maximum leverage at peak prices. Corporate ownership jumped from 2 to 7% using cash, while individuals used maximum debt. When leverage unwinds, wealth transfers from forced sellers to cash buyers. The asymmetry was engineered deliberately. But there's a deeper layer that exposes the true orchestration behind the housing trap. The mortgage system generates derivative instruments that allow institutional players to profit from both expansion and collapse phases, while homeowners absorb all downside risk. Banks package mortgages into securities, sell them to pension funds, then purchase credit default swaps that pay out when mortgages fail. Homeowners fund their own wealth destruction through interest payments that finance the derivative positions betting against them. Higher loan amounts generate higher fees and larger derivative positions. The mortgage wasn't designed for repayment. It was designed for extraction during expansion and collateral capture during contraction. This move was prepared through systematic regulatory capture that enabled unprecedented leverage while creating legal frameworks that protect institutional interests during the unwinding process. The preparation required perfect coordination between mortgage originators, securities packagers, derivative markets, and regulatory authorities. The timing required precise synchronization across credit markets, housing supply chains, and institutional positioning. Someone with complete access to mortgage market data, credit derivative intelligence, and regulatory coordination authority designed this system to achieve a specific outcome. The systematic transfer of housing wealth from individual ownership to institutional control through leverage manipulation disguised as market accessibility. And the evidence suggests this wealth transfer is already underway through mechanisms that remain invisible to homeowners who believe their property represents stored wealth rather than collateral for institutional profit extraction. The leveraged positions were created systematically through underwriting standards that prioritized loan volume over repayment capacity. 63% of mortgages issued since 2020 went to first-time buyers using minimal down payments at peak price levels. These buyers believe they own appreciating assets. They actually own liability positions in a system designed to extract their wealth through forced liquidation when credit conditions normalize. The institutional buyers who accumulated properties with cash during the same period positioned themselves to acquire additional inventory at distressed prices when the leveraged positions become unsustainable. Corporate ownership isn't an investment strategy. It's a wealth consolidation mechanism that uses housing collapse as the transfer vehicle. The mathematical impossibility becomes clear when measured against debt service capacity versus income growth. Housing costs consume 25% of median income historically. They now consume 41% and rising. This gap cannot be sustained through normal economic growth. The only variables that can adjust are prices, which must fall, or incomes, which cannot rise fast enough to close the gap. The resolution requires forced liquidation by over-leveraged homeowners and opportunistic acquisition by cash-positioned institutions. The wealth transfer happens through mathematical necessity rather than conscious choice. But the housing collapse represents only the surface mechanism. The deeper objective targets the entire American middle-class saving structure through systematic destruction of property values as wealth storage. Home ownership traditionally provided ordinary families with inflation protection and multi-generational wealth accumulation. When housing becomes unaffordable or loses value, middle-class savings get destroyed while institutional ownership concentrates property control. The collapse isn't designed to crash housing permanently. It's designed to transfer ownership from individuals to institutions at distressed prices, then reinflate values under concentrated ownership. Someone engineered this ownership transfer through leverage manipulation that appears to help homebuyers, but actually positions them for systematic wealth extraction. The trigger mechanisms are already active through derivative market stress that remains invisible to homeowners focused on monthly payment calculations rather than systemic risk exposure. Deutsche Bank announced $1.2 billion in losses on real estate derivatives. That represents the first visible crack in a derivative system worth $210 trillion in notional exposure tied to housing debt. When derivative counterparty risk materializes, credit markets freeze instantly. No credit means no buyers. No buyers means forced selling at any available price. The mathematical cascade becomes unstoppable once derivative chains start breaking. Each failure triggers margin calls that force additional liquidation, that pressures prices lower, that creates more derivative failures. Homeowners get caught in this cascade through no fault of their own. Their debt service remains constant while their collateral value collapses, and their refinancing options disappear. The system traps them in depreciating assets with no exit strategy, except forced liquidation at the worst possible timing. Someone designed this trap through derivative complexity that homeowners cannot understand and positioning they cannot access. The wealth extraction happens through institutional sophistication rather than individual irresponsibility. The preparation required years of coordination between mortgage markets, derivative exchanges, and regulatory frameworks. The execution requires precise timing across credit cycles, interest rate movements, and institutional positioning. We're not watching random market forces. We're watching choreographed wealth transfer disguised as housing correction. The choreography reveals itself through institutional behavior that contradicts their public statements. Banks sell mortgage portfolios while publicly maintaining bullish housing outlooks. Hedge funds accumulate cash, while rating agencies maintain positive credit assessments. The smart money positioning contradicts the public narrative because the smart money understands the mathematical inevitabilities driving the system. 40 million homeowners remain unaware they're positioned on the wrong side of the largest wealth transfer in American history. They believe their homes represent security when they actually represent collateral for institutional profit extraction. The transfer begins when derivative market stress creates credit contraction that eliminates refinancing options and forces distressed selling into illiquid markets dominated by cash buyers. The timeline has already begun. The positioning is complete. The mathematical requirements are non-negotiable. By the time the housing collapse becomes obvious to everyone, the wealth will have already been transferred to entities that prepared for decades, while individual homeowners believe the illusion of permanent property appreciation. The cascade sequence operates through 3 convergent pressure waves that eliminate all exit strategies simultaneously. Each wave amplifies the others until mathematical resolution becomes the only possible outcome. The first pressure wave targets commercial real estate liquidation that destroys bank capital before residential mortgage stress becomes acute. $1.5 trillion in commercial real estate debt matures between now and the end of 2026. These loans financed office buildings that are now stranded assets with occupancy rates below 40% in major metropolitan areas. The buildings generate insufficient rental income to service existing debt. Refinancing becomes impossible because valuations have collapsed 30 to 50% below outstanding loan balances. Default and liquidation at market clearing prices becomes the only mathematical solution. But commercial losses flow directly into the balance sheets of banks that also hold residential mortgages. Commercial real estate destruction eliminates bank capital and forces tighter residential lending standards to maintain regulatory compliance. Someone engineered this dual exposure by concentrating commercial and residential real estate risk within identical financial institutions. The concentration ensures commercial losses trigger residential liquidation regardless of individual loan performance. The preparation reveals coordination between commercial development financing and residential mortgage origination that created maximum institutional vulnerability to real estate collapse across both sectors simultaneously. The second pressure wave operates through consumer debt cascade that eliminates household cash flow available for mortgage payments. Consumer debt reached $17.5 trillion with credit card balances exceeding $1.1 trillion at delinquency rates, approaching post-2008 crisis levels. Average households service multiple debt obligations using income streams that have not increased proportionally to debt service requirements. When cash flow becomes insufficient to service all obligations, households prioritize survival expenditures over mortgage payments. Mortgage payments represent the largest single expense but provide no immediate utility compared to food, transportation, and healthcare costs. When triage becomes necessary, mortgage payments get eliminated first despite representing the largest asset positions. This creates mortgage default waves that reflect income inadequacy rather than property value changes. Defaults begin before home prices decline because households cannot maintain payments regardless of collateral appreciation. Someone calculated this cash flow breakdown when implementing policies that expanded consumer debt faster than income growth. The mathematical inevitability ensures mortgage defaults accelerate before early warning signals from property values alert the broader market. The third pressure wave accelerates through institutional rebalancing that forces professional selling exactly when individual homeowners need liquidity most. Corporate investors maintaining 7% of single-family home inventory through institutional vehicles must maintain specific return thresholds for pension fund and insurance company clients. When property appreciation slows below required returns, redemption pressures force asset liquidation regardless of market conditions. Institutional selling creates downward price spirals that accelerate individual homeowner distress through comparable sales that establish new pricing below homeowner expectations. Pension funds, holding mortgage-backed securities, face quarterly mark-to-market requirements that force selling into declining markets when underlying home values trigger rebalancing mandates. Insurance companies must reduce real estate exposure when solvency ratios fall below regulatory thresholds. The institutional selling occurs at precisely the moment when individual homeowners discover refinancing has become impossible and equity extraction is no longer viable. Corporate liquidation removes natural buyers from markets while forcing individual recognition of mathematical reality. Someone positioned these institutional triggers to activate simultaneously when housing markets show initial stress. The coordination ensures professional selling amplifies individual distress rather than providing contrarian stability. The convergence creates perfect storm conditions where individual homeowners face impossible choices with no viable alternatives. They cannot refinance because equity positions are underwater. They cannot sell because institutional liquidation has eliminated natural buyers at current pricing. They cannot maintain payments because other debt obligations have consumed available cash flow. The mathematical resolution requires individual liquidation at whatever prices institutional buyers consider attractive for a distressed acquisition. The prices reflect forced selling rather than fundamental value assessment. But the housing cascade represents only the surface mechanism for deeper monetary system transformation that targets dollar-denominated savings as the primary wealth storage vehicle. Housing wealth traditionally provided middle-class families with inflation hedge and generational savings accumulation. When housing becomes a liability rather than an asset, ordinary household wealth gets redirected into institutional control through systematic value destruction. The destruction isn't random market volatility. It's engineered wealth transfer that concentrates property ownership while eliminating individual wealth accumulation through real estate appreciation. The entities positioned for distressed acquisition prepared for systematic consolidation. They accumulated cash while others leveraged. They avoided debt while others borrowed against phantom equity. They preserved optionality while others committed to unsustainable obligations. This positioning reveals understanding that housing cycles extract wealth through expansion and collapse phases rather than creating lasting value. The preparation required coordinated manipulation of credit availability, regulatory standards, and institutional positioning across multiple economic cycles. Someone with complete authority over monetary policy and regulatory frameworks engineered this outcome through decades of systematic positioning. The mathematical requirements become clear when measured against debt-to-income sustainability. Current mortgage debt levels require continued home price appreciation to maintain refinancing ability and equity access. Without appreciation, the debt becomes unserviceable for millions of households. Someone eliminated the possibility of continued appreciation through interest rate manipulation that made new borrowing unaffordable, while existing borrowing became unsustainable. The timing ensures maximum household vulnerability, exactly when institutional acquisition becomes most profitable. The Federal Reserve faces impossible choices that validate the mathematical breakdown. Lowering rates to support housing markets accelerates inflation that destroys purchasing power. Maintaining high rates to control inflation accelerates housing collapse that destroys household wealth. Either choice confirms the debt levels cannot be sustained through policy management. The resolution occurs through forced liquidation rather than monetary accommodation. Someone understood these policy limitations before creating expansion sequences that guaranteed exceeding them within predictable timeframes. The constraints ensure resolution through wealth transfer rather than debt restructuring. The geopolitical timing reveals international coordination. Global central banks tighten monetary conditions while institutional investors accumulate cash for distressed acquisition. Chinese, Middle Eastern, and European entities positioned for American residential property acquisition during systematic collapse. Someone orchestrated this international wealth transfer through central banking coordination that positioned foreign buyers, while domestic homeowners maximized leverage exposure. The mathematical cascade operates through timeline compression that eliminates gradual adjustment possibilities. Credit markets freeze instantly when derivative stress triggers contraction. Buyers disappear overnight. Refinancing becomes impossible within weeks. The compression eliminates normal adjustment mechanisms. 40 million households discover simultaneously their largest asset became their greatest liability with no exit except distressed liquidation. The timeline has been established through derivative market positioning that creates automatic triggers rather than discretionary decisions. When counterparty risk reaches predetermined thresholds, liquidation occurs through algorithmic execution rather than human judgment. Someone programmed these thresholds to ensure cascade initiation before individual homeowners can react to changing conditions. The automation eliminates policy intervention possibilities that might moderate the wealth transfer. The mathematical inevitability becomes absolute when measured against available liquidity for mortgage market support. The Federal Reserve absorbed $2.3 trillion in mortgage-backed securities to prevent earlier collapse, but total mortgage debt exceeds $12 trillion. No institution possesses resources to backstop positions of this magnitude without destroying currency credibility through hyperinflationary money creation. The choice becomes systematic housing collapse or currency destruction. Someone calculated these limits before implementing expansion policies that guaranteed exceeding available support capacity. The calculation ensures wealth transfer through forced liquidation rather than monetary bailout. The entities positioned for distressed acquisition understand these mathematical constraints and prepared accordingly. They accumulated cash while others borrowed. They avoided leverage while others maximized debt exposure. They preserved optionality while others committed to obligations requiring impossible conditions to maintain viability. 40 million homeowners will discover these realities through foreclosure notices, refinancing rejections, or strategic default calculations that reveal the mathematical impossibility of maintaining current obligations. The discovery occurs whether they understand derivative market mechanics or not, whether they recognize institutional positioning or not, whether they acknowledge coordinated wealth transfer or not. Mathematics don't accommodate hope. Physics don't adjust for denial. Accounting doesn't modify for optimism. The cascade represents controlled demolition of individual housing wealth disguised as natural market correction. The demolition serves wealth concentration purposes that require systematic property transfer from leveraged individuals to liquid institutions. By the time the broader implications become visible to everyone, the ownership structure will have fundamentally shifted, and the previous alternatives will have been systematically eliminated. The 40 million households approaching forced recognition represent the intended outcome of policies designed to concentrate property ownership among entities with superior access to capital and deeper understanding of debt cycle manipulation. The wealth transfer occurs through legal mechanisms that appear market-driven rather than engineered, through individual failure rather than systematic extraction. But the coordination reveals the intention. The timing reveals the planning. The mathematical precision reveals the engineering. What appears to be natural housing correction represents the completion of the most sophisticated wealth extraction operation in financial history. And while most participants focus on interest rate movements and inventory statistics, the real forces driving surface phenomena remain hidden until the transfer is complete and irreversible.